Good morning, everyone, and welcome back to the Daily Hunt for Multibaggers. It's Friday, January 9th, 2026, and we're looking at some fresh market commentary from yesterday, January 8th.
You know, Ethan, our AI-powered analysis flagged quite a few stocks yesterday with a really interesting mix of sentiment. We saw a high volume of social media discussions covering a wide range of companies.
Absolutely. It felt like the market was grappling with a lot of big ideas, from innovative tech to more traditional defensive plays. Overall, I'd say the sentiment was cautiously optimistic, but with a clear undercurrent of risk, especially in the high-growth sectors.
Agreed. Many users are chasing potential, but the underlying KPIs tell a story of high valuations and some very real financial hurdles for several of these names. It's definitely a day for discerning between hype and genuine opportunity.
All right, let's jump right into it. First up, the big one, Apple Inc., AAPL. We saw conflicting sentiments yesterday, which is interesting for such a bellwether. One post was really bullish, predicting AAPL to revisit $275 in 2 weeks, talking about crushing sales and future innovations like foldable phones.
Well, Ethan, while the optimism for Q4 sales and future products like foldable phones is understandable, our AI-generated insights strongly suggest a stay away here. Even with that bullish buzz, the KPIs are screaming caution. Apple's price-to-earnings ratio is still very high at 34.7, and its price-to-book ratio is an astonishing 51.9. That kind of premium demands exceptional growth, but its reported revenue growth is a rather modest 7.9%.
But Brooke, it's Apple. They're the king of all stocks for a reason. New products, strong brand loyalty, and the sheer scale of their ecosystem suggests that 7.9% could easily accelerate with new innovation.
Perhaps, but then you look at the debt-to-equity ratio at 152 and a recent analyst downgrade to $245, below the current price. We also saw news of Alphabet overtaking Apple in market capitalization, which indicates shifting investor preference. Given these metrics and the bearish sentiment from another post about lack of innovation and being overpriced, the downside risk seems quite high for that price target. Our previous rating for AAPL was a buy on January 3rd, but with this fresh data, we're downgrading it to a stay away. Moving on to another tech giant, NVIDIA Corporation, NVDA. We had 2 analyses on this, and both ended with a stay away recommendation. The news about China potentially approving H200 chip purchases should be positive, right?
Oh, absolutely, Brooke. That China news is huge. NVIDIA is at the forefront of AI. Their revenue growth is a phenomenal 62.5%, and their net profit margin is an astonishing 53%. They're deploying Blackwell GPUs, CEO Jensen Huang's talking up AI advancements. This company is a powerhouse, It feels like the growth potential is limitless.
Limitless growth is a great narrative, Ethan, but the price-to-earnings ratio is still very high at 45.6. That means a lot of future growth is already priced in, and even massive news might not move the needle much. More concerning, insiders have been net sellers of over 3.5 million shares in the last 6 months. Those closest to the company might see the stock as fully valued. Plus, the debt-to-equity ratio is also quite high at 9.1. Our last rating for NVDA was stay away yesterday, and our AI-generated insights maintain that, stay away.
Speaking of semiconductors, let's talk about Advanced Micro Devices, Inc., AMD. The market chatter on this one was quite skeptical, even when tied to the positive NVIDIA news.
Indeed. The analysis concluded a stay away, and for good reason. AMD has an extremely high PE ratio of 107.7 and a high price-to-book of 5.48. This stock is priced for perfection, and any minor hiccup could lead to a significant drop. Its beta is 1.95, meaning it's nearly twice as volatile as the market, living up to those roller coaster comments we saw.
But, AMD is making strategic moves in AI growth and server shipments. They showcased new chips at CES, and there's been some insider buying. They're strong competitors, challenging Intel. That innovation could justify the higher multiples long-term.
It could, Ethan, but the high debt-to-equity of 6.36, coupled with that extreme volatility and the overall market skepticism we picked up, makes it a very high-risk entry point right now. Our previous rating for AMD was speculative gamble on December 22nd, but with the current data, it's a clear downgrade to stay away. All right, let's shift gears completely to a more defensive play, Coca-Cola, KO.
This one was flagged as a defensive cash flow play in a volatile market, and for good reason. KO is the epitome of a stable long-term investment. That consistent dividend yield of 2.94%, its low beta of 0.387 making it less volatile than the market. It's a sleep well at night stock, you know? Wells Fargo even added it to their Q1 2026 tactical ideas list.
You're right, Ethan. Its PE ratio of 22.97 is fair for its historical averages, and it provides that reliable income stream. While the revenue growth is modest at 5.1% and the debt to equity is high, KO has a proven track record of managing that. For investors seeking stability and consistent income, our AI-generated insights suggest a buy. This is a new rating for KO on our podcast, by the way. Next up is Next NRG Inc., NXXT. We had a lot of chatter around this one, some highlighting its niche in microgrids, AI research, and strong revenue growth of 253% year over year. There's even been some insider buying. That's a company building something truly innovative in a high-demand sector, you know? Ethan, I hear the enthusiasm, and that 253% revenue growth figure is impressive. But you have to look at the whole picture here. Our AI-generated analysis strongly recommends a stay away, and it's based on some critical red flags. The company is deeply unprofitable, with a net profit margin of negative 86% and negative EPS. The price-to-book ratio is a concerning negative 8.75, which means their liabilities exceed their assets.
But the peer-reviewed AI research and strategic partnerships, they're building credibility, and the market for microgrids is huge. Plus, the stock is near its 52-week low, so maybe it's a good entry point if they turn the corner.
The potential is there, but the risks are too high. One user post even mentioned lender litigation around an alleged default. That indicates severe financial instability. While insider buying is positive, it's not enough to offset the profound unprofitability and balance sheet issues. We've rated NXXT a stay away repeatedly since October, and that rating unfortunately holds today. It's a stay away. All right, let's discuss Ondas Holdings Inc., ONDS. This one really got social media buzzing, with talk of drones, so hot right now, and impressive gains. Oh, absolutely, Brooke. Users are ecstatic, reporting X4.5 year-to-date gains and up 46% since December 29th. There's talk of a FIFA World Cup counter-drone contract and a defense program for Israel. This company is in a cutting-edge sector, you know, with a lot of room to grow. The stock is soaring, hitting 4-year highs.
Ethan, that's a classic case of very bullish sentiment running ahead of the fundamentals. While the stock has seen a huge run and is near its 52-week high, Ondas is still unprofitable, with a net profit margin of minus 1.72% and negative EPS. Its price-to-book ratio is a very high 9.49, meaning a tremendous amount of future growth is already priced into the stock.
But the autonomous systems orders, the rebrand, Investor Day, these are all catalysts pointing to future revenue growth that simply isn't reflected in those past numbers yet, you know?
Exactly. The reported revenue growth is a modest 5.82%, which just doesn't justify the current valuation and hype. While future orders could boost revenue, the current unprofitability and high premium make it a very speculative play. We've consistently rated ONDS as stay away since October, and the AI-generated insights continue to suggest stay away. Finally, we come to QXO Inc. This was presented as a boring roofing roll-up company with potential for explosive growth.
And it's true, Brooke. This company has seen its stock rocket 18% with a new $1.2 billion investment from Apollo Global Management to fund future acquisitions. That's massive validation for their roll-up strategy. Plus, we've seen substantial insider buying and a whopping 207% revenue growth. This isn't boring, this is exciting.
Ethan, that revenue growth is impressive. But for the average investor, the current unprofitability is a major concern. The net profit margin is minus 3.8% and EPS is negative. While the Apollo investment and insider buying are strong signals, and they do have the potential to turn those profitability KPIs around, it's still a high-risk scenario until that growth translates into sustainable positive earnings. User comments also express skepticism about the explosive growth narrative, suggesting more modest utility-like returns. As such, for now, our AI-generated insights lead to stay away. This is a new rating for QXO on the podcast. Investigate as buy, Coca, KO. Investigate as cautious buy, none. Investigate as speculative gamble, Ondas Holdings Inc., And
that brings us to the end of another week of the daily hunt for multibaggers. What a session.
Always a wild ride, Ethan.
Indeed. Now, for our standard but crucial reminder.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset.
Thanks for tuning in, everyone. Have a fantastic weekend, and we'll catch you next time on the Daily Hunt for Multibaggers.